Last week, the Malaysian Ringgit fell to a 25-year low relative to the USD. With 1 USD hitting a peak of 4.79 Ringgit, this is the worst the Malaysian Ringgit has been since the Asian financial crisis in 1998. So today, I'll be talking about two factors that's impacting our exchange rates. One talks about the USD and how it's kind of just strong right now, whereas the other talks about why the Malaysian Ringgit in particular is weak. I mean, after all, we are the second worst performing currency in Asia this year, only better than the Japanese yen. I'll also talk about how all of this impacts us as Malaysians, so stay tuned till the end. So the first reason that the Malaysian Ringgit looks a bit weak right now is that the USD is just extremely strong. So just remember, whenever we look at an exchange rate, there's two sides of the equation. Even if the Malaysian Ringgit does nothing at all, but the USD is strong, then the exchange rate will go higher and higher. And over the last 2 years, the USD has been extremely strong. So why is this happening? With economic uncertainty and wars going on, investors tend to go to the USD as a safe haven. People talk about stuff like real estate, gold, all those kind of stuff, but in reality, when things go wrong, people will go to cash. I mean, cash is king after all, and they won't just go for any cash, they will go for the USD. On top of this, the US has faced some really bad inflationary pressures over the last 2 years. In recent times, it has gotten better, but the way that they solve this is by increasing their interest rates. So, for example, the Federal Reserve, which is the central bank in the US, they've set an interest rate of 5.25%, whereas in Malaysia, Bank Negara has an OPR of just 3%. So there's a big gap between the interest rate in the US versus Malaysia, and this has caused investors to go for the USD over the Malaysian Ringgit. So to explain this, let me give you guys an example. CIMB offers fixed deposits in both Malaysian Ringgit and foreign currencies as well. So if I wanted to put a fixed deposit for 1 month and I deposit Malaysian Ringgit, I would get a 2.6% annual return. What if I wanted to put a fixed deposit in another currency? Basically, nearly every other currency out there, they're offering a higher interest rate, and the highest of them all is the USD. So as an investor, obviously I would go for the highest interest rate because I want the highest returns, so I would rather put my fixed deposit in USD versus Malaysian Ringgit. Imagine this on a much larger scale. Obviously, me as a retail investor with my 10,000 ringgit, I won't make a big impact by choosing Malaysian Ringgit or USD. After all, the currency market is huge. But when you think about institutional investors, when you think about high net worth individuals, once they start doing more and more of this kind of stuff, then it can really impact the exchange rates. So now, not only is the USD considered a safe haven, they're also offering the highest interest rates in the market. And the USD is not just strong against the Malaysian Ringgit. It's actually strong against nearly every other currency out there. There's this index called the DXY, and it measures the USD against 6 other major currencies like the GBP, the Japanese yen, and the euro. Ever since 2022, the DXY has gone up by 10%, which in currency terms is extremely high. Even Indonesia, last week or I think 2 weeks ago, the central bank made the unexpected move to increase their interest rates because they wanted to save their currency and because the Indonesian rupiah hasn't been performing so well against the US dollar. So coming up, I'll talk about why and how the Malaysian Ringgit in particular is being extremely weak, and then after that, I'll explain how all of this impacts us as Malaysians. So drop a like on this video if you're enjoying it so far. So we know that the USD is strong, but why is the Malaysian Ringgit weak? We are the second worst performing currency in Asia this year, only after the Japanese yen. Japan has their own issues, their interest rates are even lower than ours, but what's going on with us? There are so many factors to this, but one of it is that our exports has been declining. So ever since March of this year, Malaysia's exports have declined on a year-on-year basis for the last 7 months in a row. Why does this matter? Basically, when exports go down, it means that countries are buying less products from Malaysia. And when other countries buy less from Malaysia, it means that they don't need so much Malaysian Ringgit, so demand for Malaysian Ringgit is low, which will cause the value to drop. So you see, the thing is, usually a weaker currency will support a country's exports. So let's say, for example, we sell palm oil to another country. Previously, they pay $3 for 1 kg. Now, because our currency is weak, they only have to pay $2 for 1 kg. So technically, it should be cheaper for them. They should be buying more of our products, but the reality is, it's just not happening. Right now, the Malaysian Ringgit is weak, and our exports are declining, so it's kind of like a double whammy for us. So the reason for this is that many other countries out there are going through their own economic challenges, and this includes our largest trading partner, which is China. So because the economy is bad, even though prices for them to import is cheaper right now, they're still not doing it, which is basically why all of this is happening. So we know the reasons of why the Malaysian Ringgit is dropping against the USD and why the Malaysian Ringgit is weak. But how is this impacting us as Malaysians? The first thing is obvious. Any products that we import from another country is going to get more expensive. So for example, easy one, Apple has increased the price of the iPhone over the last 2 years in a row. The iPhone 13 Pro started at 4,899 ringgit, whereas the iPhone 15 Pro starts at 5,499 ringgit. So there alone, we can already see a 10% increase in price. So we could overcome this by buying local. Obviously, buying local stuff will help because everything is Malaysian Ringgit and hopefully it won't be so expensive, right? The thing is, a weaker currency can also lead to imported inflation. What imported inflation means is basically, let's say Malaysia as a country, we import a lot of rice, which in fact we do. We do import a lot of rice. So now, restaurants who import rice from other countries, it costs more for them to do so because we have a weaker currency. So the cost for them to produce food goes up, and what do? When costs go up? They basically pass this on to the consumers, so us as end consumers, we end up having to pay higher prices. Another thing that Malaysia imports a lot of is petrol, and I'm pretty sure we're paying a higher price for it right now. So we don't feel this as end consumers because the government has subsidized it. They have set a ceiling for the price of RON 95 petrol, but it's still the country's money. Also, next year, once they roll out targeted subsidies for petrol, once they remove subsidies for a certain amount of people, then we will really start to see the impact of a weaker currency on the prices of petrol. Unfortunately, I don't have an answer to this problem. It's a very difficult situation, and if I didn't have the solution, I wouldn't be making this YouTube video. I'd be calling up Bank Negara, telling them and going to work for them. They're in a very tricky spot. Should we follow Indonesia and raise our interest rates to support our currency, but that comes at the cost of consumers like me and you having to pay more on our loans, and the economy will probably take a hit too when we raise interest rates. Let us know down in the comments, what would you do? Would you raise interest rates to save the currency, or you just let everything be as it is and then just try and weather the storm? If you enjoyed this video, give us a huge thumbs up and subscribe to our channel if you haven't already. If you enjoyed watching this video, you'll probably enjoy this video as well.